Hello and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. You know, there's one number a lot of retirees watch closely every fall, and no, it's not their fantasy football scores. It's the Social Security Cost of Living Adjustment, or COLA. The Social Security Administration recently announced the 2026 COLA, and it's coming in at 2.8%. That's a modest increase, but it still means a little more breathing room for millions of retirees. According to a recent Kiplinger article titled 2026, Social Security COLA is 2.8%. What you need to know, that 2.8% increase may translate to about $56 more per month for the average retiree, bringing the typical monthly benefit to around. For married couples receiving benefits, the increase could be closer to $88 a month, raising the typical combined total to about $3,208. Now, that's not a dramatic jump, but in an economy where prices are still rising in areas like groceries, gas, and medical expenses, even a small adjustment can help offset some of those day-to-day costs. Interestingly, this year's announcement was delayed a bit because of the recent government shutdown. Some Bureau of Labor Statistics employees were temporarily called back just to finalize the Consumer Price Index report, and that's the data used to calculate the COLA. So, while the news came a little later than usual, retirees can now plan around that new number for the year ahead. When we look at this 2.8% adjustment in context, it actually lines up pretty closely with what we've seen historically. Over the past 20 years, Social Security's cost of living adjustments have averaged around 2.6%. So yes, 2.8% is modest, but it's not unusual. Current inflation is sitting at about 3%, and projections for next year are slightly lower than that. So this increase may help many retirees mostly keep up with their everyday expenses. I say mostly because the average retiree's personal rate of inflation is often higher than the national average. Why? Because retirees typically spend more on things like healthcare, housing, and prescriptions, which are categories that tend to rise faster than the overall inflation rate. So even if the math says 2.8% is reasonable, someone who's watching their out-of-pocket medical costs climb might still feel like they're falling behind. If you look back over the past decade, you can really see how wide the swings have been. In 2016, for example, the COLA was literally 0.0% because prices in many areas were flat or even declining. Fast forward a few years, and in 2023, when inflation surged after COVID supply disruptions, the COLA jumped to a whopping 8.7%, one of the biggest increases in recent history. Since then, the numbers have cooled off. We saw 3.2% in 2024, 2.5% in 2025, and now 2.8% for 2026. So what we're seeing now looks much more like a return to normal. And here's the interesting part. A lower COLA isn't necessarily a bad thing. A number around 2% to 3% is actually typical, and it often signals that inflation is stabilizing, not heating up. A COLA of 8.7% usually means the economy is under stress. A COLA of 2% or 3% may not sound exciting, but it can mean prices are steady, and that stability can make it a little easier for retirees to budget and plan. So how does the Social Security Administration actually come up with that COLA number every year? It's not a guess. It's based on a formula tied directly to inflation. Specifically, the SSA uses something called the Consumer Price Index for urban wage earners and clerical workers, or CPIW. That wasn't always the case. When Social Security first began, Congress had to pass a new law each time they wanted to raise benefits. But in the 1970s, inflation was running so high that retirees' fixed incomes were losing purchasing power quickly. So in 1972, Congress passed an amendment to make these adjustments automatic, and the first automatic COLA took effect in 1975. Today, the Social Security Administration compares the average prices from July, August, and September to the same 3 months from the previous year. The percentage change between those two averages becomes the COLA for the next year. It's essentially a snapshot of inflation during that 3-month window, not the entire year, but it still gives a solid benchmark for how the cost of living is trending. There have been proposals to base the COLA on a different inflation measure called the CPIE, which focuses specifically on Americans age 62 and older. Supporters argue that it would better reflect the spending habits of retirees, especially since it gives more weight to healthcare costs. So far, though, those proposals haven't been adopted, partly because Social Security benefits don't just go to retirees. The COLA also applies to disability and survivor benefits, so the government has to consider fairness across all recipients. Now, here's something a lot of people don't realize until they're already receiving benefits. If you're collecting Social Security and you're still working, your earnings may temporarily reduce your monthly benefit. This is called the earnings test, and it applies to anyone who starts claiming benefits before reaching their full retirement age. For 2026, the Social Security Administration will withhold $1 in benefits for every $2 you earn above $24,480 per year, which works out to about $2,040 per month. If you're earning more than that, say from part-time consulting or side work, your monthly benefit could be reduced. But here's the key point. Those withheld benefits aren't lost forever. Once you reach full retirement age, the SSA recalculates your benefit amount and gives you credit for the months when payments were withheld. So it's really more of a timing issue than a penalty. And in the year you reach full retirement age, the rules become more lenient. In 2026, the SSA will withhold $1 for every $3 earned above, or roughly $5,430 per month. If you're planning to keep working while easing into retirement, it's worth understanding where your income stands relative to those thresholds, because careful timing and planning may help you avoid surprises and keep your retirement income strategy running smoothly. And while we're on the topic of numbers that may affect your income, let's look at another Social Security adjustment for 2026, the taxable wage cap. This is the maximum amount of income that's subject to Social Security taxes, and it also determines how much of your earnings count toward future benefits. For 2026, that cap is increasing to $1,084,500, up $8,400 from $1,076,100 in 2025. That means any income you earn above $1,084,500 next year won't be taxed for Social Security purposes, and it won't increase your eventual benefit either. This cap typically rises each year because it's indexed to inflation. Over just the last few years, it's gone from $1,068,600 in 2024 to $1,076,100 in 2025, and now to $1,084,500 in 2026. And if inflation continues at a similar pace, you can expect it to climb again in 2027. If you earn above that limit, your take-home pay might get a small bump once you hit the cap mid-year, since you'll stop paying Social Security tax, but that extra income doesn't translate into a higher Social Security check later. Understanding how the wage cap works can help you set realistic expectations for both your current paycheck and your future retirement benefit. Here's another number to keep in mind for 2026. How much you need to earn to qualify for Social Security work credits. These credits are what determine whether you're eligible for retirement benefits down the road. To qualify for Social Security, you need at least 40 credits over your working lifetime. You can earn up to 4 credits per year, and without enough credits, the SSA simply can't pay you retirement benefits. In 2026, you'll earn 1 credit for every $1,890 in wages or self-employment income. So, earning at least $7,560 in 2026 will give you the full 4 credits for the year. For comparison, in 2025, it took $1,810 to earn a credit, about $80 less. So you can see how that threshold gradually rises with inflation each year. These credits don't just determine retirement eligibility, they also play a role in disability, Medicare, and survivor benefits. So even though it's something that happens behind the scenes while you're working, it's an important part of your future benefits picture. Now let's shift to one of the most impactful decisions you'll ever make about Social Security, which is when to claim your benefits. Timing can make a big difference. If you wait to start collecting until age 70, your monthly benefit may increase significantly. The SSA adds roughly 0.2% for each month you delay after your full retirement age. That's about 8% more per year. So if you wait until 70, your benefit could be roughly 28% higher than it would have been if you started right at your full retirement age. On the flip side, claiming early comes with trade-offs. For those born in 1960 or later, starting benefits at age 62 may reduce your check by about 30% compared with waiting until your full retirement age. And if you're claiming spousal benefits, the reduction can be even steeper, up to 35% if taken early. Remember, a spouse's maximum benefit is 50% of the worker's full retirement amount, and that percentage is applied after any early claiming reduction. That's why some people look at what's known as a Social Security bridge strategy. That means using savings or investments, like an IRA or 401k, to cover living expenses for a few years so you can delay claiming Social Security. By doing that, your Social Security income has time to grow to its full potential before you start drawing it. Everyone's situation is different, but for those who have other retirement assets to lean on, waiting to claim may help boost that guaranteed income stream for the rest of their life. If all of this sounds like a lot to juggle, that's because it is, and that's where guidance from an experienced financial services professional can make a real difference. A financial services professional can run detailed claiming scenarios, show you the break-even points for each option, coordinate your Social Security with your retirement accounts, and help you manage taxes so that more of your income stays in your pocket. They can also help you design a retirement income strategy that balances guaranteed income, like Social Security, with flexible income from savings or investments. That way, you're not just planning for numbers on a spreadsheet, you're planning for the life you want to live. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.